Hello friends, Astrologer Mohnish here. Thank you for watching my videos on Vedic astrology and financial astrology. Now, a lot of my members, my subscribers, my platinum members who are using my VIP indicator too, they ask me a simple question. When the market goes down, what shall we do? Shall we book the losses? Shall we just quit the trades? Shall we sell our portfolio? What should we do? Now, this is $1 million question, and this is why I always tell you that you need to learn option trading. When you learn option trading, you can change any game in your favor. Okay, I have done it multiple times. I do it every day. So I'm going to show you one example first here. Maybe last time I showed you how you hedge your portfolio using the VIX options. When you know VIX is going up, the markets will come down. So watch that video if you have not watched it. I'll put a video link below for that hedging your trade, the strategy. In this video, I'll show you very simple strategy. When market comes down, you can make money by selling covered calls. Okay, how you sell covered calls, what are the requirements you need? I will cover that step by step. So stay tuned and watch this video to the full, and we'll take an example of NVIDIA stock. I currently holding 400 stocks of NVIDIA, and I'm still selling covered calls on every day and making money every week on it. So I'm going to show you the strategy what I use. You need to use the same thing. So stay tuned and watch this. So here you see my screen. Our VIP indicator for NVIDIA is showing that downward trend just started, right? So you see the red mark here, that the momentum towards upward, which was here, went here. People booked their profits, and now the retracement is happening. Now you will start panicking. Oh my God, I bought it at 135. I bought it at 136. What shall I do? Okay. So let's assume in this example, you bought NVIDIA at 135. Okay. So let's say 135 is the price. You hold NVIDIA. Okay. For me, I bought the NVIDIA when it was 128. And since then, I'm selling 140 covered calls multiple times. It hit 140 also, but then it came down. And this is where the profit is when it comes down from 144. The options expired of 140 covered call, and I take all the premium in my pocket. Okay, so this is what we do, but I'm going to show you step by step what you should do. Let's assume you have $135 an average price of NVIDIA stock, and you minimum hold 100 stocks, because 100 stocks is what you need to sell one option contract. Okay, so each option contract is 100 stocks. So if you have 100 stocks, you can sell one covered call. If you have 200, you can sell 200. If you have 300, you can sell 300. So this is how the assumptions and the requirement of the covered calls are. So let's assume you have $135 price of each stock of NVIDIA, and you hold 100 stocks of NVIDIA. Now, what will happen and how you put your covered calls, I'm going to show you step by step. So stay tuned. This is my platform, Interactive Broker, from where I use my option trading. I do my option trading. So all you need to do is go to this platform, Interactive Broker, or any platform you are using. You go to new window and say option trader. So your platform will show you this particular window, option trader. Okay. Now click on NVIDIA. So bring the NVIDIA instrument here, and then you will see all the options with the expiration date. These are the calls and these are the puts. November 8th, November 15th, November 22nd, 29th. These are the dates when the options are expiring. So the criteria to pick the best option to sell is to see the implied volatility. The more IV is, the greater the premium you will get for the options you're selling. So the thumb of rule is, normally what we do is, if the IV is greater than 52 percentile, we sell options because you can take a lot of premium in that. If the IV is less than 50% or 52%, we buy options because we know we are not paying any much premium, and then we can literally make money by the price moving in the direction what we are anticipating. Now, in this example, we know we have bought the price of NVIDIA at 135, multiplied by 100 stocks. So we hold 100 stocks of NVIDIA. This is our hypothesis. Okay, this is our hypothesis. Now we want to sell an option because we know the price of NVIDIA is retracing. It may go to 132, 130, 129. We don't care where it goes. Okay, because we know it's a very good company. Fundamentals are very strong. It cannot go zero. Okay, and there's again many more techniques to hedge the downward risk also, which I will be covering in my maybe next videos. But here is, you hold the stock 135. 100 stocks of Nvidia. It could be any other company also, but this is for an example. And then how you keep making money on it again and again and again. I'm showing you this. So let's say this is your stock option. These are the option chains we have. I will pick with the highest IV within the range of 20 to 30 days. So you see 65.8% IV gives me a very good, very decent amount of premium. And it is expiring in 90 days also. So 90 days is a very quick way of making money. And not like more than 30 days, 40 days. Sometimes I do 45 days, 50 days option selling also to get more premium. But for you, start with something less than 30 days. Okay, so now click on this. And these are the call options and put options. We're looking for call. Call means that we are selling at a price higher than the price what we are where the stock is trading at present. So what we'll do is we will be looking at something at 140. Let's say that. Okay. So the price of the stock you have bought at 135. Let's say we pick the 140 because 140 has a good delta. Delta means how much the option will go up and down based on the price of the stock. So let's say if option delta is 0.45, that means every dollar move upwards of Nvidia will make our option expensive by 45 cents. Okay, so delta means how much the option will be becoming expensive with $1 move of the stock. Okay, so you can just simply search these technicals if you need to, but understand this is a very good delta 45. Okay, for our option. Now let's say 140. We're a little aggressive. We can pick 144 also, but I want to be very aggressive with this strategy where I want to take $600 premium instantly. Okay, so let's take this, and what I'm gonna do is I'm gonna click on here, say sell, and you see can here sell is coming here on my platform. I will put a limit order of a mid price. You will see in the real stock trading, the brokerage is telling you what is the bid and the ask, and you can pick something in the middle. Okay, and then what you can do is you right click in here and say show me my performance profile. What is my profit and loss right? So now here you see this is a performance profile. We bring the last date of expiration, that is November 21st. Okay, now understand this, November 22nd is when it is expiring. I'm going to bring that here. Now it's very easy. You understand, if let's say stock is 135 you bought and you're selling 140 of a covered call for this particular stock. So you are pocketing 655 right now. 655 will come to you as a premium right now, the moment you sell this. Okay. And this 65 is yours. That means till the price of this stock does not reach 146. Okay. 146 is a break even. You see that 146.57 break even. You are always continue to keep 655 in your pocket. Nobody will take this out from you. Okay, so 146 is the break even because the person who is buying this option, he is anticipating that today market may be at 135, 136, but 140 is I'm buying, plus I'm paying you $6 premium for buying this option. So 146 is the price of the stock. The person who is buying this option is anticipating that he will make money if price goes above 146. Till 146, the person will not exercise this option and you will still pocket 655. So this 65 always remains yours no matter what. Okay. So now what will happen if stock goes back to 139, 138, 135, you still pocket 655. You already made $6 worth of profit on this stock without even selling the stock. Stocks is still with you. So let's say on two scenarios happen. On 22nd of November, stock end up being at the price of 140. Okay, let's say that. What will happen is you continue to hold your 100 stocks. You still have the stocks in your bucket, in your portfolio, and you already made 655, which is yours. Nobody's taking this out from you. Okay. Anything happens below, you still have 655. Okay. And the stock is very good. You know that it will hit one of its support level and then start moving upwards. Okay. And again, as I said, if you have a risk of more going downwards, and you still hold this stock at the price of 135, you're just losing money in the books. You're not really losing money because it's only in the books that you see that stock is, going to 125, 130. Oh my God, I'm losing $1,000. No, it's just the unrealized profit and gains. Okay, you still make $600 and the stock will bounce back because technically these stocks are very, very solid. I will also cover one day that how you hedge your downward risk also. It's very easy. Okay, we can buy and sell a put spread also. To do that, that you want to make sure that the stock doesn't fall below 125, so that your portfolio doesn't get more damage. So I'll talk about this in maybe next video. But in this video, we know the stock will be hitting one of its zones, as per my VIP indicator, the support zones, and then move up. But we are want to get the premium till the stock doesn't reach to 146. Now, other scenario is, like, say stock won't reach at 148. Now, what will happen? If stock reach 148, you lose your 100 stocks at the price of 146. That's all. Okay, you already made $600 and you sold this stock at 140. You still end up making $600 profit in that particular deal. What you lose is you lose psychologically $200, that, oh, I would have made 200 more. That's all. It's a psychologically. I would have made if I would have sold it at 148. But we are not targeting that. We are happy making $600 worth of profit. Okay, so you bought it at 135, you sell it at 146, you still made $1,100 profit, not 600 actually, because 135 was your price. So I'm gonna redo it. 135 was the price of your buying. Okay, stock moved to 148. You already got $6 as your profit when you sold these options. So $6 in your pocket plus the option contract was 140. So $5 again, because you sold the stock at 140 and you bought it at 135. So you make 5 here plus 6 as a commissions. Commissions means the premium you got when you sold this option. You made $11 profit on each stock, which is equal to $1,100. All you're losing is, like, stock is 148. You could have made $200 more if you would have sold at 148. That's only a psychological loss, not a real loss. So $1,100 you made a premium, even if the stock moves upwards in the direction which we were not anticipating it to move. Okay, so if stock moves to 150, you still make $1,100. Your psychological loss is $4. Stock moved to 160, you still make $1,100. Your psychological loss was, in this case, was 146 minus 160, $14. So this is all psychological losses. Okay, that, oh, I would have made this much more. Fine, that's it. But what you do is you wait for the stock to retrace and then you buy more stocks and then do the same game again and again and again. Don't be greedy. If you are happy getting $1,100 for a stock in 18 days, why won't you take it? And this is what the people, the professional traders, they do it again and again and again. So friends, this is what the smart trading is. Okay, you need to play with options in today's day and time to make money. I'll show you many more scenarios that how the wrong trade gets into profit just by using options. Options gives us such a big ability to hedge our trades, sell the covered options, do anything you want to do. Okay, and you don't have to realize the losses, because option gives you the ability to make money still even if you're in losses. Okay, and change that loss into your gain. This is a covered call. So you need 100 stocks of at least one stock to use the covered calls, because your platform will give you that much of margin. They know it, you own the stock. When you sell the covered call, it is against the stock what you're holding. Okay, so Apple, Nvidia, Amazon, Facebook, Meta, Google, they are the very highly liquid stocks. They are fundamentally very strong companies. They will never go to zero. So don't worry about their pullback happens. The pullback is good, healthy. It's not a crash. Make money in the pullbacks. Okay, and then if you are very much concerned about downward risk, then the put options can be used to even hedge the downward risk, that the price of the stock should not go lower than, like, if our hypothesis was 135, should not be going lower than 120 or 122, something like that. So in next video, I'll show you how to do that. But this is what you need to do. And I've been doing it again and again and again. Nvidia, Amazon, Meta, lots of stocks we do. And easily in 15 days, if you're making $1,100 on one stock, okay, you can play a little conservative game also. Like instead of 140 covered call, you would have said 142 or 145. The price will never reach there, but in this case you will get the lesser premium. So little aggression, more premium, but again nothing to lose. You still make money. Which way the stock goes, you still make money. Okay, so never sell stocks in losses. Never realize the losses. Your losses shown in your trade book are only a book, a trader's book, profit and losses. You literally get the loss when you close the position, or the profit when you close the position. So unless you close the position, You have many other ways to fix that position, bring it back to the profitability by using the option trading. So, my dear friends, use a VIP indicator and it is a game changer. As I said, we are bringing another model very soon, algorithm model, which will predict the price movement of any stocks in next 4 days with 98% accuracy. We are working on it very hard. Very soon, we're going to launch it and stay tuned for it. I shall see you in my next video very soon. Stay active, stay happy. God bless you all and stay awakened. Thank you for watching.